Hi, this is Gletzmar Igcasama and this is the GBI Accounting Lectures, where we offer understandable accounting and auditing lectures. I know, most are claiming that, but let's break it down. Our lectures are understandable because they are non-technical in nature and we use simple English in explaining. Aside from that, the lectures are storytelling and point of view based, which means we are to step in different personalities like creditor and debtor or lessor and lessee to encourage your imagination. On top of that, we will be using a lot of illustrations and examples. We will also be focusing on concepts and answering the question why instead of hows. The lectures are also designed to let you relate even if you didn't know anything about the topic. And most of all, the lecture is straightforward, meaning every sentence and every line is important and nothing is irrelevant. Also, we will also try to include all the twists of the topic. So, what are you waiting for? Subscribe and hit the notification bell to be updated on my videos, and let's start the learning. Previously, we have talked about the financial statement assertions of the management. But for those who are new to my channel and to this video, actually, you don't need to go to the previous episodes to understand this video. You can watch the previous episodes later. Now, let's start. The assertion of the management is, if you summarize it, it is that the financial statements that they have prepared are correct or fairly stated in accordance with the accounting standards. And as an auditor, you will test that assertion. So in this episode, we're going to answer, how do we test the management assertions? Let's answer that directly. The management assertions can be tested using different financial audit techniques, designed by you as the auditor, of course. Those audit procedures that we are going to talk about in this episode are the TIRO ACTI. So let's start with T, which pertains to tour of the facilities. Example, if the auditor wants to know if a certain asset is existing, he or she can tour the facilities of the audited company. Next is I, which pertains to inspection of documents. This is also a simple procedure. Example, if the auditor wants to know if a purchase of an asset really happened, he or she can inspect the sales invoice or deed of sale or any documentary evidence of the purchase. However, related to inspection, we have the procedures tracing and vouching. Let's start with tracing. Tracing is actually used to test for completeness. To understand this, remember, if you have doubts that an account balance is lacking or something was not included in the financial records, or if you doubt that an account balance or balances is understated, you must test for completeness. So, testing for completeness, if reduced to simple terms, is just testing used if you doubt that something was not recorded or something was lacking or understated. So what will you specifically do if you feel like something is lacking? Logically, you will start inspecting the source documents or look for other information and then check if they have been recorded in the financial statements. Example, if the auditor doubts that some purchases of inventories were not recognized, he can inspect suppliers' invoices and the receiving reports for items received from suppliers. And then from those, you can go to the financial statement records to check if they are recognized. So, that's what do we call tracing. So, let's summarize. If you doubt that some FS balances is lacking or understated, you should test for completeness. And how do you do that? You can do tracing from the source documents or other information to FS records. Again, because this is very important. Tracing starts from source documents or other information to the financial statement records. So again, that's tracing. The second one is vouching, which is the opposite of tracing. Vouching is used to test for existence. Test for existence is used if you as the auditor doubts that balances are overstated or you are doubting that some of the recorded transactions are actually non-existent or invalid. So here, the direction is from the financial statement records to the source documents or other information. Example, the auditor doubts that assets are overstated in the financial statements and that some of them were not really existing. So what will happen? He can then inspect the FS records, or if you are the auditor, you can then inspect the FS record and check if they are physically existing, or check if there are source documents evidencing ownership. So that's vouching. Again, in tracing, the direction is that you start from source documents or other information to financial statement records. But in vouching, it's reverse. You are going to start from financial statement records to source documents or other information. I hope that's clear. So, alright. Next is we have recomputation or recalculation. So, if the auditor has doubts as to the mathematical computations or mathematical accuracy in the FS prepared by the management, then he or she can recalculate. Next is we have observation. So, on the TIRO ACTI, we are now in the O. So, if you are the auditor, you can observe the actual processing of accountable transactions to determine if written policies are really followed in the actual processing and recording of accountable business transactions. This is a technique used by the auditor to gather information directly. Because as you know, evidence gathered directly are more reliable than gathered indirectly. So if you want to know more, actually, observation is used in knowing if segregation of duties are followed by the organization. I'll expound about this segregation on my video about internal control. But for now, you need to remember this. The custody of assets, the approval of transactions, and the recording functions should not be merged under one person or should be segregated, because if not, then there will be a very high risk of fraud and corruption. So, you can give a certain employee multiple positions, but make sure that if he is a custodian, for example, of some assets, then his or her second or third position must be related also to custodianship still. So that's it for observation and intro to segregation of duties. Up next are the lengthy ones, the analytical procedures and confirmation. So stay tuned. Let's have analytical procedures. Actually, analytical procedures are just procedures used to find out account balances with relationships which are unpredictable. To understand that, for example, if you are to find an entry which is debit expense and then credit income, what will you think? It's unusual, right? But even if it is unusual, you cannot conclude immediately that it is wrong. You still need to investigate those accounts with unusual relationships, because there are times that those are actually correct and explainable. Actually, in my example, debit expenses and credit revenue is actually possible if we talk about not-for-profit organizations which are receiving services from someone like lawyers or CPAs for free or as a donation. So the concept of analytical procedures in simple terms is just finding the unusual transactions and investigating them. It's as easy as that. And since these procedures focuses in unusual transactions, account balances with predictable or reasonable relationships are not investigated further. But if you wanted to be more technical, analytical procedures is actually a process of developing your expectations as a practitioner and then comparing those expectations with the actual data. And if there are significant differences, then investigate further. Later, we are going to have to apply this in sample scenarios or illustrations. But before that, let's talk about how are we going to develop these expectations. Expectations can actually be derived from paint. It can be developed from prior period financial statements. Like for example, the current year is 2021. Then you can study FS from 2020, 2019, 2018, and backwards and develop your expectations from them. A is for anticipated results like budgets or estimated future financial statement amounts made by the company. It can also be a source of expectations. Expectations can also be extracted from interim financial statements. But what are interim financial statements? Those are financial statements covering less than a year of transactions. Like for example, we have quarterly or monthly or semi-annual financial statements made by the company. And lastly, expectations can also be derived from non-financial information and your technical knowledge and skills. To make your learning complete and concrete, let's apply it to situations. Let's start with an example related to these three. Example, the prior period sales is 1 million and the cost of sales is 500,000. This information, let me make it clear, can also be extracted from these two, the anticipated results and interim financial statements. But in this example, we will assume that the data comes from the prior period FS, okay? So let's continue. If the current year sales is 1.5 million and the cost of sales is 1 million, is the current cost of sales reasonable? That's the question. Now let's have the first step in the analytical procedures, which is the developing of expectations. But how do we do that? Most practitioners will make use of different techniques, like for example, ratio analysis. So let's use that. In this example, we have to get the cost ratio of the previous year by comparing or dividing the cost of sales with sales of the previous year as the basis. So 500,000 divided by 1 million, and we will get 50% as the cost ratio. So in developing expectations, we need to ignore this actual current year's cost of sales right here and apply this 50% cost ratio with the current year sales. So 1.5 million times 50%. So our expected current cost of sales should have been 750,000 and not 1 million if the sales and cost of sales relationship of the previous year was maintained. So that is how you develop expectation using prior period FS, anticipated results, or interim financial statement amounts. And of course, that is how you use the ratio analysis technique in developing expectations. So there are a lot of ratios. So if you want to master ratio analysis, I have a link on the description which will lead you to my financial statement analysis part 1 lecture. Now let's go to the step 2 of analytical procedures, which is the comparison of expectation versus the actual amounts, which is 750,000 versus 1 million. And if we're talking about cost ratios, we have 50% versus 66.67. And then the difference is 250,000 as to amounts, and as to the ratio, we have a difference of 16.67%. And the question is, are the differences significant? Answer, yes, if we're only going to base on the available given information in the illustrative problem. But if it's given in the illustrative problem that the company's cost of sales and sales are usually fluctuating due to, for example, changes in the market prices of the product or the prices of the inputs necessary for production, then maybe the difference can be not so significant at all. However, since that information is not provided here, then we can conclude that there is a significant difference, so the difference shall be investigated further. Sir, how about this too? Non-financial information and technical knowledge. How do we develop expectations from this? Okay, let's start with non-financial information. What if you as the practitioner sees that there are a lot of employees getting fired from their jobs, or the turnover or changing of employees is very fast? Or, this might be exaggerated, but what if you witness that the company employees are destroying their personal computers and documents because of the upcoming audit by the Securities Exchange Commission, just like in the movies, and you also have noticed other non-financial signs of bankruptcy? The question is, what will be your expectations related to the company's income in the financial statements? Of course, you should be expecting that FS should show huge losses, right? But what if you saw their FS having large amounts of income? Is that a significant difference from your expectation or observations? Clearly, yes, right? So you need to investigate further. And lastly, related to the technical knowledge, what if you saw that an interest expense is recognized even if the company has no liabilities recognized in the FS? Isn't it weird? Is this a significant difference from what you learned? Yes. So again, investigate further. So that's analytical procedures for you. And if you understood the concept and application of this, you will be able to detect unusual relationships and fluctuations, which sometimes can lead to discovery of corruption and fraud. So that's it. But before we end this, please remember this too. Number one, analytical procedures is a must in a financial statement audit, specifically in the planning and the completing the audit stage. And number two, analytical procedures is optional in the substantive testing stage, or in simple terms, the stage of actual evidence gathering. We have here confirmation as an audit procedure. The concept of this is simple because this is just the sending of confirmation letters to customers. So if you are an auditor and you wanted to know if the receivables reflected in the financial statements of your audit client is correct, then you can send these confirmation letters. You can also send letters to suppliers to confirm the payables of the company that you're auditing. And of course, you can also send confirmation letters to the bank to confirm cash in bank balance or balance of loans payable of your client. It's easy, right? However, it gets deeper than that. Actually, there are two types of confirmation. So we have positive confirmation and the negative confirmation. So positive confirmation is when reply is necessary from the respondent. Example, you wanted to ask few customers of your client with large AR balances to know if the accounts are correct, because you have doubts that these receivables are overstated. So based on this, you can actually send positive confirmation letters to them. And if those customers do not reply, then send another confirmation letter, or you need to follow up if ever, because they may be forgot. So that's positive confirmation for you. While in the negative confirmation, you don't actually need replies from the respondents. The tone for negative confirmation letters is just like this one. Sir or ma'am customer, the balance of your payable in our records is 10,000, for example. If this coincides with your records, then don't reply anymore. So that's the tone. Of course, most of my students normally ask, why is it that we are still using negative confirmation letters when it is very clear that sending positive confirmation letter is much more effective? First of all, they are correct, since positive confirmation is much more effective, because if we're talking about negative confirmation letters, if the respondents don't reply, you can't be sure if the record coincides with the audit client's records, or they just forgot, or they don't want to reply. However, positive confirmation is sometimes inefficient. Imagine this. If the audit client has 100,000 customers with accounts receivable amounts from them which are immaterial, and you chose positive confirmation, you will be expecting 100,000 replies, which if reviewed is a total waste of time. So I have here a summary that will guide you on what to choose between positive and negative confirmations. So number one, if accounts of respondents are material, then choose positive confirmation. On the other hand, if the accounts are of smaller amounts, then choose negative confirmation for efficiency. Number two, look at the number of the accounts or number of respondents. If there are only a few, then use positive confirmation. But if there are a lot of respondents, then use negative confirmation letters. Here's a nice question related to this. What if there are accounts that are large in amounts, and there are also accounts with immaterial amounts. So what will you do? Of course, you can send positive confirmation letters to respondents with material accounts and negative confirmation letters for those who have immaterial account balances. And we have number 3. They are the same on the negative and positive confirmation. Actually, in this number 3, it talks about the limitation of confirmation technique as a whole, or regardless if it is a positive or negative confirmation. It does not really matter. Let's elaborate. If we are talking about receivables, you can only use confirmation technique or confirmation letters if you feel like the balances are overstated. Or in other words, you wanted to test for existence. Because if that's the case, the respondents will really react and correct the balances. On the other hand, if you are doubting that the receivables are understated, please don't use confirmation letters. Because if I am your customer, for example, and you told me that my balance is just 1 million, when in fact it is really higher than that, then I will happily say, you are correct, my balance is just 1 million. Of course, when we talk about payables, the rules are reversed. You can only use negative and positive confirmation letters when you feel like the payables recognized by your audit client is understated. Or in other words, if you are to test the completeness of the payables only. So that's it. Now let's apply to different examples. Example number 1, you're auditing Gletz's company. In the books of the company, you found that the accounts receivable is 100 million from 10 customers only. So each customer has a similar account balance or about 10 million per customer. Again, I'll repeat it because this is very important. There are only 10 customers or targeted respondents with 10 million account balance on the average for each customer. So situation number 1, if you wanted to test the existence of the accounts receivable, or in simple terms, if you doubt that the balances are overstated, then question number 1 is, can you use confirmation technique for auditing? Answer, yes, because if you feel like the recorded balance of receivables is overstated, then if you ask them about it, the respondents will likely to object and give corrections. Question number 2. What type of confirmation are you going to use? Of course, positive confirmation, because it is appropriate to account balances that are material. And also in the example, there are only a few customer accounts. Now let's go to situation number 2. If you wanted to test the completeness of accounts receivable, or in simple terms, if you doubt that the balances are understated, the same question in number 1 here. Can you use confirmation technique for auditing? Answer, no, because the respondents will likely say, yes, you're correct, sir. That's your receivable from us. And since you cannot use confirmation technique, you need to use other auditing procedures. Like for example, checking if all inventories sent and sold to customers are recorded in the financial statements. Now let's go to example number 2. It's the same with example number 1. However, there are already 100,000 customers, with each of them having 1,000 each as their average account balance. So here, there are a lot of customers, but they have an immaterial account balance. So number 1 again. Situation number 1. If you wanted to test the existence of the accounts receivable, or again in simple terms, if you doubt that the balances are overstated. So question number 1 again, can you use confirmation technique for auditing? Answer, yes also. But what type of confirmation is appropriate? Of course, it's already the negative confirmation, because in this example number 2, the account balances are not material and there are a lot of customers. So situation number 2. If you doubt that the balances are understated, the same question number 1, can you use confirmation technique for auditing? Answer, no. And since you cannot use the confirmation technique, again, you need to use other auditing procedures. Now, let's go to example number 3. This is basically the same with example number 1. However, here the receivables became payables. So everything in example number 1 will also be reversed. So in situation number 1, if you wanted to test the existence of the accounts payable, or in simple terms, if you doubt that your balances are overstated or the accounts payable is overstated, then question number 1, can you use confirmation technique for auditing? The answer is no. Because if I am the supplier and you sent me a confirmation letter confirming an accounts payable balance of, for example, 1 million, when in fact it's actually lower than that, then I will definitely say yes. That's the correct balance that you owe me, 1 million pesos. So what are you going to do if confirmation can't be done? You need to use other auditing procedures. Like for example, checking if all the inventories recorded in the financial statements from the suppliers are actually received or actually owned by the company already. Because sometimes you can record purchases, debit, and accounts payable, credit, even if the title for such goods are not yours yet. But in scenario number 2, if you wanted to test the completeness of the accounts payable, or in simple terms, if you doubt that the balances are understated, the same question number 1, can you use confirmation technique for auditing? Yes. And the second question, what type of confirmation will you use? Of course, positive confirmation letter, because the account balances here in this example are material and there are only a few supplier respondents. But then again, if in the example, if the amounts here per supplier are material or immaterial and the supplier slash respondents are too many, then negative confirmation will be used. Actually, the confirmation letter, even if sent by the auditor or practitioner, are actually signed by the audit client. So the steps are in this picture. So step 1, the auditor sends the request to client for approval. Step 2, the client reviews, signs, and returns the confirmation to the auditor. Step 3 is just the sending of confirmation to the responder. And step 4, the responder replies and sends his or her reply to the auditor. And that's it for confirmation. And then we have transaction walkthrough, where the auditor checks the full process of a certain transaction from start to finish. Example, on the transaction of salaries of employees. Sure, the ending point is the recording of debit salaries expense and then credit salaries payable and other credits if ever. And upon payment, we have salaries payable debit and credit cash. That's what we know. But we also know that it started from somewhere. It started from the login and logout data of the employees. And that data, aside from being organized and summarized, it also passed through verification and checking. And after that, payroll preparation and computation of salaries follows. So in this phase, deductions from late or absences and mandatory deductions by the government are made to get the net salaries of the employees. And after approval of the payroll computation, it will be prepared for payment before it is reflected to the financial statements. So, in the transaction walkthrough, the auditor will check from the beginning to the recording of the transaction. That's from here to here. That's transaction walkthrough. And lastly, we have inquiry, or plain asking of questions. If you are the auditor, don't expect that you understand more of what's happening in the client's environment. You don't. People in the organization, especially those that are present every day, knows more about it than you. So you need to ask them. You can ask people outside the organization like customers, competitors, government agencies that the audit client is reporting to, or to people inside the audit client like employees, top management, and others. So that's inquiry. Now, before we end this video, I would like to summarize again. This video is meant to answer how are we going to test the FS assertions of the management. The answer is TIRO ACTI, which stands for Tour of Facilities, Inspection of Documents, Recomputation or Recalculation, Observation, Analytical Procedures, Confirmation, Transaction Walkthrough, and inquiry. And that's it. Next episode, we will try to answer the question, why do we need to test the management assertions? Thank you for visiting my channel and for watching the videos. If this helped, please click the subscribe button and hit the notification bell for my next videos.